Thanks so much for attending. Well, we did a seminar a month ago, and that was, well, what if the Democrats take control? And I wanted to add all kinds of things to it, so they made me wait, and now it's happened. So it's really a time for planning now. We know some of the opportunities with respect to avoiding the estate and gift tax that exist are going to go away. So we are going to present to you a few of the strategies we recommend, especially for highly wealthy people, to utilize some of these benefits before they're gone. I think one of the themes of today's seminar really has to do with the idea that we can move assets that would be taxable by the government out of the taxable estate while retaining income. A lot of clients come in with the reluctancy to move value away from themselves, which is totally understandable. But when we can work through a strategy where the client retains liquidity, retains income from that asset, and oftentimes control in terms of how to invest the asset, what to do with the asset, not sales proceeds control, but income control and control over how the asset is utilized, we can kind of work everything out, avoiding estate and gift tax without, giving up what the client's really worried about, which is really the income and some control. I'm going to turn it over to Brian so we can get started with some of the actual technical strategies. Brian and I work together on these strategies, both domestically and internationally. So go ahead, Brian. Let's go ahead and start on some of the strategies.
Maybe let's get rid of the video so they can see
exactly.
the slides, not us.
Yeah, sure. Okay. There you go.
All right. Okay, so just to give an overview, an agenda, if you will, of what we're going to go over today, sort of an introduction, which Gary has already talked about a little bit, about what's happened and what is predicted to happen based on the proposals that have been made during the presidential election season by President-elect Biden, and then now that the Democrats will control both houses of Congress, it's very likely that a lot of these things will come to pass. The other will be just based on that knowledge, what to do from a planning perspective to utilize the techniques and the strategies that exist now, and then because they're probably going to be going away. Mm-hmm. And then also just sort of an update on changes that have been made for IRA planning, based on the Secure Act, which has been in effect now for over a year. But there are some things that, from a planning perspective, we should be aware of, and then also potentially utilize because of the current climate that we're in. And then lastly, some cautions to be aware of as you speak with your clients, and things for them to be thinking about, and perhaps some strategies for them to implement in this year. Then we'll end it up with some conclusion and questions. Okay. So now that 2020 is over and we've lived through COVID, we had a very contentious election, and now we're really going to see things converge between the markets, which are at all-time highs, but we also have the effect of what's going on Main Street, which,
and we have some areas of the market that are very low also, which is actually, we have several clients involved in those areas, which is a separate factor.
Right.
So
Yeah, absolutely.
It's a mixed bag.
It's a mixed bag, and a lot of times, especially in the media, you see the emphasis on the market, which is important, but at the Main Street level,
the Dow,
the Dow, the Standard & Poor's, but at the local level and even the regional level, a lot of businesses are struggling, and the effect of that long term, it's really going to have an effect both on the economy in general, but also on their individual planning if they own their business and what they're able to do. COVID is
oftentimes also, we have a few larger clients that are involved in entertainment, event, um, these related industries that deal with stadiums and people getting together, basically, restaurant hospitality, um, where they've gone down so far. The drop has been so deep that we can go from $100 million valuation to like a $10 million valuation, just because people in general, the market doesn't know what's going to happen. However, the client really has a pretty good idea of what's going to happen. And generally speaking, that means, especially with respect to these highly viable businesses, that they'll recover entirely in value within a year, 2 years, or 3 years, whatever the number is. And so now we have the opportunity to move assets out at this tiny value with no impact.
Right.
Basically no impact.
That's right. And plus, with the interest rates being as low as they are, the ability, it's another factor, especially on sales, to intentionally defective granted trust, and the AFR being so low, I mean, historically low, the opportunity to do planning and to freeze value at a low amount and get it out of the estate and to watch it explode for beneficiaries later is just an amazing opportunity. So even with these dark clouds,
once every 10 or 20 years has happened.
Right. So that being said, that kind of gives you an idea from the perspective of introduction of where we're coming from and the opportunities that present themselves in this type of planning. Obviously, with the election now and with the Democrats taking complete control of Washington, they have some proposed changes that are going to drastically impact your clients, both from the perspective of estate tax and planning and income tax as well, both from the individual side and from the business side. And we'll highlight some things that have been proposed, and it's very likely now with full control it's going to happen.
Well, in some form.
In some form, for sure. And especially with the climate right now, the ability to, especially if it's taxes on the rich, is very likely to push through in Congress. So that being said, the last thing to keep in mind as well is that it's very likely over the next 4 to 5, 6 months, as if these tax changes take place, that the market might drop again over time. And so keep that in mind as well. Okay. Now, I'm sure you can remember over the last year how much the market has fluctuated. We have some stats here from last year in January when it was at an all-time high, and then when it got to its lowest point in March, down to 18,000, and then 2,200 at the S&P, and then as of last week, it was at all-time high again. So the market as a whole has recovered, is now at all-time highs, but as Gary mentioned, certain areas have not recovered.
And a lot of privately held stuff is not recovered. Private business is a great way to plan. Great way to plan.
Right.
Very proven, trodden area.
So, just these are things with this in mind. This is where we currently are and the opportunities that present themselves. Okay, so first off, let's give an idea of where we are now from the perspective of estate tax and planning. The exemption amount has been indexed to inflation for the last few years, and so for 2021, under current law, the new exemption per individual is 11.7 million. So that's 23.4 million for a couple that they're able to utilize under current law. Now, it's been proposed that Mr. Biden has, I should say, President-elect Biden has proposed that the credit be dropped to 3.5 million per individual, not indexed, and he also would like to increase the rate of tax to 45%. And right now it's at 40%. So there will be an increase there. Something to keep in mind. That's been confirmed. It's on his website. That's what's proposed. We'll see what happens. But
we'll see what happens. But what's the obstacle at this point?
Right. Exactly.
It's not,
I mean, there's not really an obstacle. I mean, and it's especially the credit amount. I mean, to clip that is nothing.
Well, there's no political, obstacle to that, to doing that. What do they call that? Front one?
Yeah, that's right. There's no real downside to that. Now, from the perspective of planning, obviously that's a huge deal because right now we're playing with over $11 million each. Dropping down to 3.5 drastically reduces.
It's 11 million, and we're going to go through a few strategies where we can actually leverage that to a much larger amount of money that we can get out.
Right. Secondly, and also what's probably a much more drastic change that may or may not happen is it's been proposed to eliminate the automatic step up at fair market value basis at death for anything that is inherited from a decedent. That would be a huge change from the perspective of planning, but also from taxation, because not only will assets be exposed to the estate tax, but then the heirs receive them, the beneficiaries get them with a transfer basis, which means that they're going to pay capital gains on any subsequent disposition of the asset or whatever it is.
Even if it's subject to the estate tax.
Yes. Yes.
Unbelievable.
Unbelievable. So if that ends up happening, then the historical way of thinking of how to plan, there's no real reason to keep things in your estate when you die because there's no step up anymore. So before there would be an analysis of, okay, do I have any highly appreciable assets that I should perhaps own and not get out of my estate because I want to step up? Maybe I'll expose them to the estate tax, but my heirs will get a step up in basis.
In other words, if you make the gift, you don't get the step up. You get it out of your estate at a discount, which is the strategy of lifetime gifts and what we're going to go through. But the alternative, the drawback was you don't get this step up at death, this automatic step up at death. They take away the step up at death. And the idea is to get it out now, keep some income on it, let it appreciate outside of the grantor's taxable estate, and just die without it because you're not going to get the step up anyway.
Right, exactly. So that's something to keep in mind. This is probably a harder sell than just the exemption amount, but something to definitely keep an eye on.
I don't think it's even getting that hard now.
You don't think so? Okay.
No, I don't, because you have to realize the only thing in the way of getting rid of all of these estate tax issues are the people giving money to Democrats now. That you have some wealthy people that are fun, whatever side you're on, that's the fact. I mean, so a lot of the groups give to both, honestly. So those people are terrified, like, well, what if I leave 20 million in my estate and I've got a $1 basis? I've just saddled my kids with a humongous capital gain issue. And so this issue of political support and control and the PACs and the donors will tie directly to that step up in basis issue. So that's going to be a really interesting debate. It's kind of like it may happen this year, maybe it'll be effective next year. We're kind of hoping that it's not backdated, because at this point you could be in a backdated 2021 situation without a step up in basis. The writing on the wall does not suggest that. The writing on the wall, my understanding is, suggests a 2022 likely kickoff of the disaster. But it's not out of the question.
No, not at all. And so from the annual exclusion gifts is still $15,000 for 2021. That's not going to change, at least right now. But things to keep in mind is there's also been proposed income tax rate increases that they have discussed. Currently, in 2021, under current law, the marginal rate, which is 37%, is at over $628,000 for a married couple and $523,000 for an individual at 37%. The proposed increase in taxes, at least on the income side, will be the marginal rate will be at $400,000, and it'll be bumped up to 39.6%.
I wouldn't hesitate to say that that's very likely.
Right. I would agree with that. Secondly, as relates to FICA taxes, they have proposed that over $400,000 that the taxpayer will pay 12.4% on all their wage income above that, no matter how high it goes. So there'll be a donut hole between 137 and 400,000 where people don't pay anything.
That's a gap, but I think that gap's going to be temporary.
Think?
Yeah, I do. I think that's that. Well, they've been negotiating that gap as Democrats versus Republicans, trying to say that, well, there's a gap for the middle class. There's a gap for the middle class. But when that gap, when the reasoning for that gap goes away, in other words, well, now we're all in the same party. We don't really have to appease anybody in the other party by creating a gap for the middle class. I think the gap may even go away. It's just going to take off. They're just going to eliminate.
I agree.
The cap on FICA. Right.
And then also, that's very important for our clients, especially, is it's also proposed that right now capital gains are taxed at a preferential rate.
Right.
0, 15, or 20, depending on the tax bracket.
Plus the 3.8.
Plus the net investment income tax, which is 3.8. So the marginal rate for capital gains at the highest level is 23.8% under current law. It's proposed right now that capital gains being taxed at the marginal income rate,
like a short-term gain,
right, at 39.6%, starting at taxpayers with a adjusted gross income of 400,000 or more.
But yeah, and I wouldn't be shocked if that occurs. What's going on in terms of the shift is it's what's known as the progressive shift. So progression in taxes, has to do with as you make more, you pay more, obviously. But we're going to likely move, depending on who controls the government, to an idea of what's generally known as means testing. So as tax benefits are rolled out, they're curtailed by saying, well, yes, we're going to roll these tax to incentivize business or to incentivize savings or whatever we're going to do on a personal or corporate side, but we're going to clip them as people earn more money. And then I hope this doesn't happen, but what's happened in different countries is later down the road is we then do a wealth test. So we'll clip them as you earn more. That's been going on for years in the U.S. But now we're going to we'll also clip the benefits if you have a certain amount of assets. Don't be surprised if that. I would be surprised if that goes into effect within the next few years. But you may start to see rumblings of ideas of that. I don't know. Brian may have a similar comment.
No, I think that I would agree. I don't see any right now. There's no impediment from them that being incorporated, because that seems to be a platform.
Well, that's where wealthy people go. I mean, the idea is that these people earn huge amounts of money over the course of their careers, and then they tone down or they move to tax-free municipal bonds. Their taxable income falls. Their rates are more favorable. They use tax-deferred strategies. They use what we're going to talk about today in the next minute here. And the idea would be, well, how do we eliminate that? Because that doesn't fit the progressive income tax structure that's been avoided. Well, we go to a wealth-based test. We're moving toward that, and that's going to require a huge amount of planning.
Yes. Some other things, just individually, there's more discussion about bringing back what is the piece limitation on itemized deductions, which basically at 28% of value, that's as high as your itemized deduction will go, and then it's phased out up to 80% of your itemized deductions based on your income bracket. They're talking about bringing that back. And then lastly, for individuals, the qualified business income deduction would be capped Anything above 400,000, it'll be phased out. So that is from the individual side. Just some highlights from the corporate side, which there are also some things here that will affect clients. One is the corporate income tax rate being increased to 28% from 21. There'll be a minimum tax on certain corporations that have more than $100 million in gross income. There's discussion to double the tax on GILTI, which is for the foreign.
That's a minimum tax you'd pay for foreign operations.
From 10.5 to 21%, which obviously is a large increase.
That's actually a massive. Yeah, that will shift some strategies associated with operating businesses offshore.
Also, it's also been proposed to assess it on a country by country basis.
That's not a surprise though, because what happens is you end up jurisdiction picking, even with this minimum tax. So there is some strategies that are likely going to be like the doubling of it. That sounds a little escapist, but
and then lastly is the last one. There is a proposed new 10% surtax on corporations that offshore manufacturing and services to foreign nations in order to sell goods back to the U.S. So that would be on top.
Yeah, that'll be interesting. The enforcement side of that will be interesting. That's tricky.
Okay, so that's where we are there. Now we sort of have the background and what we potentially are looking at. We can start discussing opportunities
on the estate tax.
On the estate tax side, first off is the utilization of a grant or retained annuity trust, or GRAT for short. This is a time-tested technique that's been around for a long time.
Well, it's in the code. It's allowed.
It's actually in the code currently. There's been discussions to get rid of some of this stuff. This one, since it's been around for such a long time, it doesn't have quite the vitriol that perhaps that a IDGIT sale does, a sale of the business, which we'll talk about later. But basically, from a fundamental level, is the idea is, as Gary discussed before, is that the grantor, the client, gives away something, an asset of some sort. Might be closely held business interest, could be other types of real estate or stocks, but they retain an annuity back. So you make a transfer, but you retain the right to receive an annuity back from this trust, with the idea that it reduces the overall value of the gift or gift taxes.
So there's a couple of goals associated with a lot of this estate tax planning, and getting stuff out at a discount is often not very hard, especially if we're looking at a privately held business. But a lot of times, we can't get enough out because the founder or the client, wants to retain the income or some substantial income. And this solves that in a lot of ways. If in fact the asset creates income, if in fact the business or whatever we're giving away, and we can give it in trust, the kids don't have to have control of it. We can give it in trust. Throws off income. This is a tremendous strategy, because we solve that issue. We solve the issue of the founder earning the income. So mom and dad want, I know these numbers, because some people sound a little crazy, but it actually does work this way. Like, they may be worth $50 million and they want, but they really, a lot of people born in the 40s, 30, 40, 50, although they have so much money, $50, $80 million, they require, let's say, $100,000 a month, or they require $200,000 a month, which is obviously a lot of money, but not with respect to their wealth. If we can pull that back out where they consume that money, we can create, out of a $20 million gift, where you'd actually use up all your credit, or you'd start to have to pay gift tax, we could reduce it substantially because we've retained this annuity. And that's kind of the theme. We've got a couple of other strategies as well that are similar, but let's go through some of the GRAT technicalities with Brian, and then we have a chart.
Yeah, and also too, something that, as we've seen here recently with a lot of the planning we've done the last 6 months, a lot of our clients have anticipated that this might happen. But with the low valuations right now, with certain types of privately held businesses, you get a double whammy of a low valuation.
It's like a freebie, the whole thing.
Right.
It's an amazing opportunity to avoid the estate tax.
So you have a low valuation, plus you get a discount for a minority interest too, on top of the annuity back. So it's an amazing
control. The founder can keep control.
And just some, the key to the GRAT though, one is that you have to establish a term of the GRAT, how long it's going to last, and the grantor has to outlive the term. That is number one.
Yeah, you have to outlive.
Because if you die during the term of the GRAT, it pulls everything back in at the appreciated value.
So GRATs are tricky because they can be used for a number of different strategies. Like one strategy is you have a short-term period where you're going to have a high amount of appreciation. So you've got this startup, or you've got whatever you're working on. We've got a tech group we just did this with, but we know in 3 years this thing could be worth 10 times. Now the appraiser doesn't agree. So the appraiser says, no, it's worth $4, it's not worth $40 million. And so we move out equity to trust for the kids, and we keep back, some type of annuity because it's earning money. Well, if we do that on a like a 4-year basis, the equity stays in the GRAT. So at 40 million, the founders just keeps their annuity, and all the equity is outside the taxable estate.
All the appreciation, everything.
That's the short-term GRAT. Long-term GRAT is more like you want this long-term annuity based on an established situation, and if you survive the 10 or 15 years, it's out of your estate.
The other thing to keep in mind is that even if the grantor dies during the term of the GRAT, it's not the end of the world. They're no worse off.
It's like the gift was.
Yeah, it's just the gift was made. You also get back the credit that was utilized. Mm-hmm. So it's not any worse off. Maybe you're out some legal fees and maybe some accounting fees, right. But it's worth the roll of the dice, because the ability right now with all these factors to get these assets out, it can be a great legacy for the beneficiaries.
Oh, it's tremendous. Very low cost.
And the other thing that's interesting about this technique is the way it's structured is that the annuity and the value of the asset itself is only appraised at the beginning, when the transaction occurs.
All the appreciation is out.
So it's one of those things to where the client has the ability to choose. Either it can be a percentage of value, or it can be just a flat out amount.
The annuity.
The annuity itself. So we have a chart here that kind of breaks down the transaction in some steps to kind of give you a demonstrative aid of what happens. But basically, you have the grantor on the bottom. In this example, we did $10 million of shares of a closely held business, where since it was a minority share going out, it was discounted 30%. So the actual face value of the gift was only $7 million. So that's the first discount. That's step one. Step two is you have an annuity amount, which is interesting. You have different ways of doing it, but in this case, we decided on just a flat out amount that the client said, I want X amount of dollars a year. So this is the total amount for the entire year of what it is that is paid to the client, the grantor, for 10 years. With all that being said, and with growth inside, it's estimated, and I'll show you the math here in a minute on the next page, but basically they're able, zeroing out the gift based on the annuity amount.
Which means that because the annuity has a value that's retained, it comes off the value of the gift, so the gift is almost zero.
Almost zero.
In value.
And then the remainder that goes to the kids is almost $2 million.
It's incredible.
It's amazing. So here's the math.
Plus the appreciation. Plus you may have a rocketed appreciation, which is just more to the kids.
Right. And so here's just an example with a $10 million gift to the well, I mean, it's $10 million, but it's discounted, but in value. So you have a $600,000 annual annuity amount, so 50,000 a month, basically. And based on all of the current interest rate and age and stuff such as that, the amount of the gift in this example is $4 million. That would be what would be on the form 709 that would be reported to the IRS. But if you look at the remainder when it's over, the beneficiaries have 8.5 million.
Yeah, it's like magic. I don't know if it's going to exist in 12 months, but it's magic now.
And these are conservative. I mean, 3% growth is very conservative over 10 years.
Yeah, this is not the tech company that booms out, that explodes. This is just a basic growth of an asset that grows slow.
Right. And on the next slide here, I have the same example, but it's just 5 years. And as you see, the shorter the annuity term, the higher the gift amount, because the annuity retained interest is worth less.
It's worth less. Exactly.
But even with this, over the 5 year, I mean, for a $7 million gift, you can see the bang is not as good, but you're still getting back, you're still getting out 9.3 million. I mean, it's still better than just a direct transfer.
Times that by 0.5 now, and that's the tax you save. It's amazing.
Yep. Okay, so that's one example of one of the techniques that can be used. The other one, especially if you have income and you would like to get a deduction now, there is the CLAT, which is a charitable lead annuity trust. Basically, you create an irrevocable trust that for a term of years will pay to a charity, and then when the term is over, it goes to your kids, or it can revert back to the individual, depending on how you want to structure it. If you want more of an income tax benefit, you would have it come back to the grantor, because they would be able to, it would be a grantor trust, and they would be able to utilize the deduction each year that goes to the charity. If you want to pass things on to your kids, it would be a non-grantor trust, and it's more of an estate tax planning.
And you get the current, the key is that you get the deduction now.
Right.
We're just giving up the asset for a while.
Right, and like the GRAT, depending on the numbers and what the payment is to the charity, you can potentially zero it out, but still give appreciated assets to your kids. So again, it's another technique to where you get both an income tax benefit and or an estate tax, depending on how it's structured.
Yeah, and we have a couple more here that we want to go through that are similar ideas of holding back value.
Right. We discussed this before. There's still the $15,000 annual exclusion amount each year, and that's per individual. And if a couple, spouses, if they elect to gift split, that's $30,000 per individual. So you can still utilize other types of trusts, and if you have a withdrawal right inside the trust, this is especially true for things like ILETs, insurance trust, that they're able to make their transfers qualify as an exclusion gift, as long as they did the crummy letter. So again, this is another way to leverage the estate to get stuff out. And it's still here. Did not increase this year, though. There are some other techniques, the most important of which in this climate is, utilizing the intentionally defective grantor trust with a sale.
So we mentioned this intentionally defective. That just means that the grantor is taxed with respect to what happens in a trust. So it's a grantor trust. It's ignored for income tax purposes. But similar to the GRAT, where we move assets to a trust and we keep back a payment. Well, and then with respect to the GRAT, we make a calculation. So depending on how many years you keep an annuity, how large the annuity payment is, etc. That's the pullback, the decrease in the size of the gift. This is a sale. This is not. This is a sale for fair market appraised value to a trust, keeping back a note.
Right. And it's interesting here, though, is that because of the way that this is structured, this was originally the IRS, starting in the 50s and 60s, thought that irrevocable trusts were a technique by the very wealthy to take advantage of the income tax brackets and push income out to their kids who had no bracket. Well, now you can utilize these rules to benefit the grantor with the estate tax. And so a intentionally defective, like grantor trust, for income taxes is disregarded, but for estate and gift taxes, it's valid. So you're able to make a transfer, utilize your credit, but the grantor can pay the income tax of the income produced in the trust, which is an extra gift over time.
But the gift is not viewed as a gift. It's not taxed. Right. It's not subject to gift tax. It's just more assets out to the next generation.
And so I'm going to go down the next slide, and I might come back, but I just want to give you an illustration of what that looks like here. You have an irrevocable trust, and so you would have to have an appraisal. This is best for a closely held business, where you're able to get a minority discount of the equity that you.
Also, the validity of it. We're more concerned about this than the GRAT. It's gone on for many years, but this could be eliminated through legislation.
It's been discussed for years to get rid of this.
And one of the exceptions to the legislation will likely be sale of a personal, a private business.
So to a related
to a related party. That might likely be an exception allowing for this strategy. We often combine the strategies. We do the sale to a grantor trust, and we do a GRAT as well, just in case something at some point is no longer respected by the IRS.
So as you can see here, there are steps, but number one, the IRS and in PLRs has stated that for this sale to have economic substance, there has to be at least a transfer of at least 10% of the seed money of the cost of the transaction. So if you have a $7 million sale, you should at least deposit $700,000 into this irrevocable trust. And we always go a little bit over that, where it's a little bit more than 10%, just so it's clear that we intend to be over that amount. That's step one, and that's based on the discounted valuation of the interest before it actually goes in. So here in the example, again, we have a $10 million equity interest that is valued at $7 million because it's discounted by 30 percentage points. So that's step one. Step two, we recommend an interest-only note that balloons at a term. The AFR right now, which is the rate you're able to charge a related party for a loan, for a midterm a loan, which is from 3 to 9 years, right now for January 2021 is 0.52%.
Is that
historically low? Now, we generally charge 1% just so it has more economic substance, but the rules say this has to be at the AFR. So it's an amazing ability. So not only can you leverage the gift itself on the 10% value of the sales price, but you can have an interest-only note that's paid by the seed money over the period of the note, and then at some point when that term ends, you would pay back the principal amount of $7 million in this case. Now, generally we set this up with the idea that there would be a liquidity event at some part in the future. So all the appreciation and all the gain beyond the interest only and it's all out.
Yeah. Let's finish up the last couple of estate planning moves.
Okay.
The slide above. And then we can go to the IRS, close out with the IRS.
One of the other things right now, which it's a great technique that's been around for a long time, but with the interest rates, it might not be as good as it has been in the past, is the qualified personal residence trust. The idea being the same, almost like a GRAT, in that you have a primary residence or a vacation home, you put it in a trust, but you retain the ability to stay there.
So the longer the period you retain, the lower the value of the gift. But you have to outlive it.
Yeah, it's the same deal.
We're doing a lot of some of these young billionaire people. They move the mansion into the Cooper. They stay there. They live there. They can change it. They can swap houses. They can sell it, whatever, buy a new one, whatever they want to do. And at the end of the retained period, it's out. The kids own it, but you've got to pay rent to the Cooper. Now, rent is some people say, well, I don't want to pay rent to my kids, but what you're doing is it's another free gift, really. You're just giving a gift to the Cupid. You pay your $10,000 a month or your $5,000 a month for the mansion, and it's out of your state. It's a very simple way to get a nice. Actually, you can do two of them, two properties out of your taxable estate.
That's right. It's a great technique. We use it all the time.
Yeah, all the time.
We always recommend it. There are some things here that may or may not apply depending on the type of capital assets you have. But if you want to harvest losses for the anticipation of income in the future, this would be a time to do it. In 2020, if you haven't already done it, you might still be able to. And then capital gains are the same. If we think the capital gains rate is going to increase, you might want to, take the profits now and be at a lower rate. And also just be aware of the itemized deductions. It's likely that that ability to make deductions will be reduced. And obviously, you can always make gifts if you want to get things out. Okay. Now, the last thing we're going to cover are the changes to retirement accounts under the Secure Act, which was actually passed in late 2019. And I'm going to hit some highlights here you just need to be aware of for your clients, one of which is they eliminated the ability to do the stretch, which historically, if you had an inherited IRA over the last, 10 years, you had the option to accept it if you were a spouse or a child of the person that died on your own lifespan. So if you were younger, you could stretch out the required minimum distributions over the course of your life, but the growth inside of the IRA would be larger than the stretch. So you would increase value and take advantage of that, and also be in a lower bracket. That's been eliminated now. And now, unless you're a spouse or if you're a minor child or you're disabled, basically, you can't do that anymore. That's gone. Now, instead, historically, if you didn't qualify, you had 5 years to take it all out. Now it's 10 years. So they've increased the time for you to take a distribution, but the class of individuals that must do it is much larger than it used to be. That's the main change. The other is that now, before at 70 and a half, you were required to take your RMDs. Now they've increased the age to 72. So that's something that's now an age change. Also, if you were in the 5-year distribution time between 2015 and 2020, Congress gave you an extra year to take out the distribution. So that's interesting. You were able to you can stretch that out more and perhaps get yourself into a lower bracket. The other thing that's interesting is that it eliminated, historically, you could no longer give to an IRA if you were above 70 and a half. If you kept working, you couldn't do it. Now that limitation's off. You can still do it now, but you're required to take your RMDs. So,
right.
So that's something that, it might work for your client, it might not, but the option is now there, especially if they're still working. Now, with this current climate, depending on what's in the actual IRA, there are some opportunities to leverage with lower valued assets, especially if it's self-directed. So that's something to keep in mind. You might be able to avoid the 10-year payout rule. So if you decide to use a charitable remainder trust, you might be able to get this, you might still be able to have the stretch, with the idea being that by putting it into this vehicle, you don't have the 10-year rule of taking it all out, but at the end of the day, though, the charity is going to get the remainder. They're going to get what's left, but you're not required to take it all out and be in your estate. So that might be something you might be able to,
you could play with that deduction.
Right.
Get a big deduction.
Right. So that's something to think about. It might apply if they have a large IRA and they're going to have an estate tax issue. This might be an option that might be there. This may or may not apply depending on the type of assets inside your IRA. You might want to convert to a Roth. This made a lot more sense when the market was way down. Depending on the stocks or what's inside the actual IRA, this might still be something to think about. but just, that's something you're just gonna have to like run the numbers. But what's interesting though is now with the change with the Roth as well as the traditional, when the person who owns the Roth dies, beneficiaries only have 10 years to take out the money. You couldn't just let it ride. They're forced to, as opposed to your lifetime. Because the Roth was great because it was post-tax money, so the growth was never taxed again.
It was essentially a missed loophole.
Right.
Of course, you'd leave it in.
Of course, you'd leave it in, right? And so they said no. Yeah. They said no mas. It's over. You can't do it anymore. So that is now gone. And then last thing here is just in 2020. So you still have the ability, because we haven't filed your returns yet for 2020. You were able to take out a distribution from a retirement account and avoid the 10% penalty if you were affected by coronavirus.
When is that? Is that the full year?
Yeah.
It's the full year. Okay.
And if you do, even though you avoid the 10% penalty, you can also distribute out your income over a 3-year period. So you don't have to take the hit all in 1 year, which is nice if you need it. Okay. They also made some changes to some 401k plans, in that if you have, non-employees who are on your like payroll, you can have a 401k with them now and avoid those rules where you don't have enough individuals and stuff in there. So they've updated that. It's kind of complicated, but that change has been made. It may or may not apply to your small business.
It's helpful though. That's a top issue.
Yeah. Okay.
It's on sale.
It's on sale. Exactly. The biggest thing I think for us here is I know it seems like things might be bad in the next 2 or 3 years from the perspective of your clients, when they're earning money, paying higher taxes, both on the income and the estate side. But hey, there are some opportunities here too, if you utilize the strategies that exist.
Well, you have to keep in mind, it doesn't happen yet on the gift and estate tax side. You've got these humongous advantages that still exist. They have not been changed. And the writing on the wall says it's not going to be changed until next year. So let's go ahead and take advantage of it while we can, because the idea that you can get $23 million out tax-free is likely going to end.
23.4.
23 point, yeah, exactly. 23.4. So we're coming up on our 50 minutes, and we would take any questions. Tony, do we have any questions? We're back. See that? Tony, do we have any questions? If not, we'll close up.
We don't have any questions right now. Why don't you continue to the other slides?
Okay, I think
we have one more.
What is?
I can click on it here.
Okay.
Okay. So can't see what's there. Just even though the Democrats have taken over, there's still a potential. There could be gridlock. If you have a senator from, say, West Virginia, Mr. Manchin, or from Montana, Tester, they might not push through some of these more extreme things. So there potentially could be that. I think it's unlikely, but the potential's there. It's very likely if these tax things end up going through in the next 6 months into a year, that the market will probably tank to an extent. They also, if President Biden he leaves office for whatever reason, it could be a lot worse with Ms.
Sure.
Harris.
Well, you could have a lot of fluctuation. Yeah, sure.
Right. But basically, there's a lot of things here. I know that a lot of the fiduciaries might be afraid, like right now, of what to do if they do have to sell or buy or like whatever. But that's something that they need to make sure that they're in contact with their financial folks, their accountants, and of course their lawyers to be led the right way.
It's a group, and it is a team approach. I mean, all of these strategies involve also making sure that you've got the right investment side strategy. Usually it's not very hard, but I think over the next 6 months, you're going to have a lot of opportunities.
I agree.
Okay.
That's right.
I do have a question here for you. Can you discuss possible retroactivity, particularly if someone makes a large exemption gift early in 2021?
Okay, well, I can tell them this. The IRS and Treasury promulgated a final regulation that relates to the applicability of the retroactiveness of a change. And we know now for sure, it's always been assumed that for sure they can't go into the prior years, tax years. Once the year's out, the calendar year is over, that's it. For the current year, if they make a change, they could make it for all of 2021. They can do that.
They can mess with the current year, but once you cross the calendar year,
Right.
they're not gonna go back.
Now, it's unlikely it would be for the entire year, because a lot of times if they're going to make such drastic changes, a lot of their donors are going to make sure they have time to plan historically, and that's what happens.
Donor issue.
Things like the whole thing with the guy
donors.
what's his name, Getty, that special code section.
Yeah, John Paul
Getty.
Getty.
Yeah, just for him, his special thing. So don't be surprised if you see that kind of stuff hidden in some 5,000 page law that no one reads anymore.
Thanks so much.